Hi and welcome, Marshall Reddick investors. We are glad you are able to make it for tonight's webinar covering rental property mentoring. It's nice to see some familiar faces on the attendance sheet. So I will be co-hosting alongside my colleague and Marshall Reddick's VP, Scott Pastel. This is actually one of my favorite webinars to do because we explain how essential my role as a real estate advisor is to my clients and to every one of my colleagues' clients. Along the way, Scott and myself will get you all to interact through a series of some poll questions, so make sure you stay alert. All right, so for those of you who don't know who Marshall Reddick is, or for those of you who aren't familiar with Marshall Reddick, we are first and foremost, licensed California broker who help people buy and sell property within California, whether that be their primary or an investment property. Also, we have a strong network of real estate professionals outside of California in our designated markets to help people purchase investment property. We are a private money lender for those who cannot qualify for conventional financing. And finally, we are a property manager in California stemming from LA to Orange County. So we also make it, possible to do all this through our team. And I always like to refer to Marshall Reddick with a team aspect because there's a lot of players that are involved with the real estate transaction besides myself, including the property manager, getting you in touch with the right lenders, getting you in touch with the realtors, tax advisors, and of course the insurance agents. So we like to consider ourselves a team, and having the right team in place is essential for success. So we have done all the homework for you, and it's just a matter of implementing the right strategy for each and every one of you. All right, so a little bit about me as far as who's talking here. My name is Garrett Stason, and I am a licensed real estate agent in California. So I help people buy and sell within California. I graduated from Arizona with a bachelor's degree in economics, and I started in real estate, or I got involved with real estate a few years back when I was working as a financial advisor. I got my license because it's always something that I wanted to do and I had in the back of my mind. And being from a family of real estate professionals, it was just something that I felt as though I needed to do. So a few years ago, I got my real estate license and ended up working out. I found the right company to get started with, and I've been here ever since. So other than that, besides working 6 to 7 days a week, I like to go snowboarding, surf, golf. So I'm born and raised in Southern California, so it's I haven't really strayed too far from the tree, but it's a great place to be right now. All right, so Marshall Reddick. What we do is, as my role as a real estate advisor, it's to help simplify both sides of real estate, so the buying side as well as the selling side. The reason we do this so well is because of the team that we work with, which includes our lenders, like I mentioned, property managers, realtors, insurance reps, CPAs. We believe, long-term in long-term wealth building. We're not a fix and flip wholesale company, get rich overnight type scheme or company. So our principles have been around since 1979, and we stick true to those still. So that's why we believe in the long-term approach to real estate investing. We are a full-service, one-stop shop. Like I mentioned earlier, we don't just help people get into investment property. There's an array of services provided along with that, with property management, the brokerage side, and also the financing and lending side as well. And my job is to make this as simple as possible for you, not to overanalyze everything, but making sure you have the right information in front of your fingertips, and again, making sure the right team's in place for you for your success. All right, so methodology. I'm going to cover all of these. These are all going to be covered in more detail for you later on, but here's a list of topics that are essential for us to tackle together. The who, what, when, where, how, and why. I'm sure you've all heard of this before at school or whether at a previous job. But these are the essential topics for us to go over in our one-on-one consultation, but just not in that order. So I cannot stress enough how important this is for not only me to understand, but for you as well. So when we sit down, whether that be in face-to-face or hold conversations over the phone, I always want to start with why. What is the reason you are investing in real estate? Is it stability? Are you scared of the stock market like some people and don't want to ride the highs and the lows? You want to find some stability within your either retirement plan or savings plan. Do you want to retire by the time you're X amount of, 50, 55, or 60, and use your monthly income to do traveling or whatever it is that makes you happy? Or is it you want to pay for kids or grandkids' education at school? So everyone is different, which is why it's essential for me to find out each and every one of these specific to you as an individual. So how can how can you, how is a big part too? Can you qualify for conventional financing? If not, what other options are available to you? It's my job to help educate you on the different types of programs available to you and what's most appropriate. Is it private financing? Is it using your 401k money? Is it doing a 1031 exchange? Making sure you understand and aware of all these different plans available to you. When? What is your time frame? It's pretty self-explanatory, but I help people who are ready to do this yesterday, and some who need some time, whether it be for whatever reasons, finances, or they're moving, or they're changing jobs, so it could be a year or 2 years out. And then, of course, everyone in between. The what aspect is probably the most important, which I will go over on a different slide. It has its own slide. But this is the most important piece to the puzzle. What is it that we're looking for? What is it that's driving you? What property class are we honing in on? Is it an A-class property for a specific purpose? Is it a B class? Is it a C class? What can you not only afford, but what are you comfortable with? What is it that's going to make you feel comfortable in this whole process? What types of properties are we looking at? Are we looking at single-family properties? Are we looking at duplexes, triplexes, multifamily, fourplexes? Condition. What condition is the property in? Is it or the age of the property? Is it a new build? Is it a turnkey property? Does it need a little bit of work? What are the differences? What are the pros? What are the cons? And then second to last, where to invest. So I help you understand each one of our current markets that we're in and help you make the most educated decision based off of your criteria, based off the what, and figuring out which area is most appropriate for you. Finally, again, like I mentioned, always going back to the team. Who's a part of this process besides myself? So getting you in touch with the right people at the most appropriate time. So before I speak again, I am going to bring up my colleague, Scott Pastel, who I mentioned was is our current VP at Marshall Reddick, and he's been in the industry for a while.
Is that something I don't know about, Garrett? Trying to tell me something?
Yeah, so without further ado, I'm going to bring out Scott Pastel, who's going to go in a little bit more.
Great job, Garrett. Hi, everybody, and thanks for joining us this evening. Excited to have you all on here. And so this presentation, which we're going to try to cover in an hour, which I think we're about 10 minutes into, as you can already see from Garrett's slides, is the Marshall Reddick system for investors. This is something that we go through and have gone through with hundreds and hundreds of people. Our entire team, our staff, including Garrett, day in and day out, go through this exact process with brand new, intermediate, or experienced investors, and the process is different for every single person. We have our outline, which we're sharing with you tonight, and we put all the pieces together. So the purpose of this presentation is to kind of open up the door and show you the methodology behind Marshall Reddick Real Estate, the education that we provide to clients, and really to walk you through the process from, I guess, that initial point of interest or that initial discovery call when we talk to you to help you figure out your goals and your time frame, but we're putting together this outline in this presentation so that you kind of understand the process of buying an investment property. Every single person is different. Every transaction is different. Your goals are different. So think of this as just an outline, and that we put all the pieces together, all of the people, all of the markets, all of the tools, all the resources we have available to you for free. If you're wondering, well, so how does Marshall Reddick Real Estate make money? Well, we're a real estate broker, as Garrett mentioned, so anytime we represent a buyer or seller, we're paid a commission. We are a lender, so we originate private money loans. Thank you. We're paid an origination point from the borrowers, and we're also a property manager. So really we are, I guess you could say, more of the ones that help you execute the process rather than just providing you education or writing a book or doing a expensive 3-day boot camp and then telling you now go figure it out. We are the one-stop shop. So again, thank you guys for joining. Now I'm going to cover, this is my background, by the way, for those of you that aren't familiar with me. So I started in real estate 11 years ago. I own a few rental properties, and you know, if you have any more questions, you know, we can always talk more detail. But I got a lot of good stuff to cover with you. So let's start off with the why. So as you can see from our happy fellow right there, who is achieved, I guess, financial freedom. This is a goal that many of us possess. We're looking to not rely on our day-to-day job, not rely on our earned income to fulfill all of our goals for the rest of our life. So for me personally, I set a goal years ago that I want to be financially independent and be able to retire at age 50. But my other half of that goal is to not want to retire and to hope to continue to enjoy what I do. But basically what that means to me is to have enough income from my rental property portfolio and enough asset value from my portfolio to be able to retire off of. And then that's just purely on the passive income from my rental properties. And of course I'll continue to keep working until, you know, I'm old and gray. But financial freedom could be a goal that some of you have, perhaps paying for children's college tuition, perhaps being able to afford a week or 2-week vacation every year, perhaps being able to just really have a little bit more free time to do some of the things that we really enjoy doing and not really having to rely on our job. So whatever your why is, that's kind of where we start. Why are we actually talking about real estate? Why are we even here tonight? You know, why are we on this webinar? What's the long-term goal? And then our advisors like Garrett will circle back and put that into short-term goals. You know, if we have a long-term goal that might be, you know, 5 years, 10 years, 15 years from now, in order to achieve it, we obviously have to put together a series of short-term goals. So when looking at building a portfolio, in order to achieve that long-term goal, our advisors will look at which property or properties will get you one step closer towards achieving that goal. But it really helps us to figure out why you're investing in real estate, what you're looking for. We've seen hundreds and hundreds of responses. You know, there's really no wrong answer, but you got to think back and figure out what is it really that I want to accomplish from my real estate portfolio. What do I want it to do for me and for my life, and how is that going to change my life financially or not financially? So that's kind of, you know, that's the fun part. That's the place to start. Now, in order to figure out how to accomplish those goals, we have to start with our method of purchase. Before we start looking at markets and analyzing pro formas and crunching numbers and really spending a lot of time analyzing individual properties and markets, we first have to figure out if we even have the ability to purchase real estate and how we'll be able to do it. So on the slide in front of you, I'm listing 6 common methods of purchase. These are, I guess, the options. Some of you may have 4 options out of these 6. Some of you may have 1 option, or some might not have any. So everybody's a little bit different in terms of what options they have available to them. So I'm going to cover each one of these in a separate slide, but we're going to go in order from left to right. So we're going to start with conventional financing and really go down that list there from left to right to evaluate what options we have available to us. So if you're taking notes, I guess what I would do is just kind of keep an eye or take note of which options exist and to kind of start thinking about which options you may have available to you. So we always start with conventional financing, and the reason we start with conventional financing is A, it allows us to leverage our savings, so we could put as little as 20% down and let the bank carry the note for as much as 80% of the property value. It also has the safest loan terms, so this is where we're going to see fixed interest rates. It has the longest amount of loan terms, so we're going to see 30-year loan terms, fully amortized over 30 years. We are also going to see the lowest interest rates. So basically what this all means is lowest cost to borrow money in conventional financing. Now, when we look at the basic requirements, I'm going to start with the down payment requirements. And what we're looking at are the rates and FICO score requirements for purchasing what's called a non-owner occupied property. Maybe that's very basic for some of you, but I'll be able to get in a little bit more detail on the next slide. So if right now currently you possess less than 4 mortgages in your name, then you're going to fit into that top section. If right now you have 4 or more mortgages in your name, including your primary, by the way, then you're going to fit into that bottom half section. So for some of us maybe just getting started, it might be a while until we get to that second section there. Some of you may already have 4 or more mortgages and may fit to that second part. So when we're buying a single unit, which is 1 unit, that could be a single family, a condo, a townhome, then it's a minimum of 20% down. And if we're buying a multifamily property, but still residential, so it has to be 4 or less units in order to qualify for residential, then we're going to be at 25% down. Now, once we have 4 or more mortgages, Fannie Mae and Freddie Mac have a little bit more stringent guidelines on credit score. So you'll notice that you have to have at least a 720 mid-FICO score in order to qualify for your 5th through 10th mortgage. And then once you get to that point, if you're looking at purchasing a single family, it's a minimum of 25% down. If you have more than 4 mortgages and you're buying a multifamily property, it's a minimum of 30% down. But there's a couple different key factors here. If you put an additional 5% down on top of your required minimum, then you'll see a lower interest rate. So I always tell people if you can do an extra 5% down, not only is your mortgage payment going to be lower, but so is your interest rate. And if you put anything more than an additional 5% down, your interest rate doesn't change. But just a little side note and something to look at, because that may increase your return on investment depending on how long you plan on holding that property. Also, when you qualify for a rental property, lenders will typically allow you to use up to 75% of the anticipated rent on the property that you're purchasing to qualify. So let's go to the next slide here, debt to income ratio. So in addition to your credit score, the other equally important factor here is your debt to income ratio. Now, the way that a lender is going to look at that is they're going to look at your total gross income, not after tax, but pre-tax income, and they're going to divide that. They're going to divide your monthly debt into your monthly gross income. And what you see here in the first bullet point, what counts as debt is anything that's going to show up on a credit report, but the minimum payments. So, you know, if you've been on time on a credit card for the last 10 years and you have a high credit score, your monthly payments are obviously going to be a lot lower. That's going to help your debt to income ratio. So what's included are minimum payments on credit cards, auto loans, mortgages that include taxes and insurance, your minimum monthly payments on any student loans, anything else that shows up on credit. You can see below that what does not count as debt. So your cell phone bills, utilities, any loans that are unrecorded, auto and health insurance. By the way, if you're paying rent, that would also be included in your debt to income ratio. So if you're really not sure where your debt to income ratio is, the best thing to do is just have a 10 or 15-minute conversation with the lender and they'll help you figure it out. But here's the basic requirement. So the higher credit score you have, the higher debt to income you're allowed to have. And this is all for investment property. If you're buying a primary residence, a home that you're going to occupy, the requirements go up a little bit, so they're not quite as stringent when you're buying a primary. So depending on where your credit score is, if you don't know your credit score, I'll give you a little hint or a little tidbit of advice. I have Credit Karma. I'm sure many of you have heard of that. Great app, desktop version or mobile app, where you can get your credit score for free from 2 credit bureaus. And so that's what I use to kind of monitor my credit every month or two. So here's where you need to be depending on your credit score. If you're on the border, let's say you have a 695 credit score and your debt to income ratio is, let's say, 46%, so you're just a tad higher than where you're allowed to be. That's where that compensating factor that you see at the bottom comes into play, which is the property that you plan to purchase. So if you're purchasing a high positive cash flow property where your rental income is much higher than your total expenses, that could potentially bring you down 1 or 2 points in your debt to income. So it really pays to be looking at purchasing positive cash flow properties in order to keep your debt to income ratios down. And probably the most important advice that I could give you guys is do not use a broker or a local retail bank for financing a non-owner occupied property. Many of us are trained, well, we bank with Bank of America, we bank with Wells Fargo, we bank with Chase, so I'll just walk in there and give them a call and tell them I'm buying a rental property out of state in Texas or Florida, and they're obviously licensed in all 50 states, and nobody there is going to tell you that they can't do it. The problem is the customer service and the knowledge of the loan officer that you're working with, the track record of the loan officer, the experience of the loan officer. Obviously, in these large retail banks, there are thousands and thousands, if not probably tens of thousands, of loan officers, and you're going to get a very wide array of experience, knowledge, and customer service. So we've learned many, many years ago as a broker that specializes primarily in investment properties to work with what's called a direct lender. This is our preferred direct lenders. This is Reed Hazard and Al Rodriguez with AMERIFIRST Financial. They are one of the lenders that we have in our resource team. They're our main preferred lender. We've been working with these guys for 12 years now. We've closed literally over 1,000 transactions with them. But the reason we work with them is they will answer your phone call at 9 o'clock or 10 o'clock. They'll answer your phone call on a weekend. If they don't answer, then you'll hear back from them within 24 hours. Weekends, nights. They have they specialize in purchase loans, so they're not like just refinance experts like a lot of the online lenders or retail banks out there. And they have a lot of knowledge in the markets that we sell property in. So if you haven't been on our website yet, we sell a lot of property in states like Texas, Tennessee, Florida, Indianapolis, Kentucky, places where you have very low, high affordability, low prices, strong demand for jobs, strong demand for rent. A lot of the states I just mentioned, I think 3 of them actually don't have any state income tax. So we see a lot of jobs going there, a lot of job growth, but still high affordability. These guys have done countless transactions in each of those states. So, and then direct lender, basically the definition, a direct lender, they have in-house processing, in-house underwriting, and they package the loan that you qualify for, and they sell it on the secondary market to Freddie Mac and Fannie Mae. So they adhere to the Freddie and Fannie guidelines. They're not brokers, so they're not adding on, their extra loan fees for that. So their costs are low, their fees are low, and their customer service is great. When you're qualifying for a loan, you want to look at 2 things: price and experience. So keep those in mind. So our advisors will help you figure out. They'll put you in touch with a proper lender and help you figure out if you can qualify for conventional financing. If that's not an option, which there may be circumstances where it might not be an option, if you're self-employed and you write off too much of your income to qualify for conventional financing. If you are, let's say, retired and you don't show enough income to qualify for financing, if you just changed jobs and you can't show that you've been in the same industry or job for at least a couple years, things like, I guess,
10 plus mortgages.
if you have more than 10 loans, if you've had a short sale in the last 4 years, if you have a foreclosure in the last 7 years, there are a lot of different reasons why some people can't qualify for conventional. So Marshall Reddick Real Estate, our company, is a private lender, and we originate loans, private financing, so not really hard money. This is asset-based lending, and these are some of the guidelines that we look at. So if you are purchasing a property, the only requirement is the down payment, and that the property has positive cash flow. So that's why the down payment requirement's a little higher, 40% down. And you have to understand that if you can't qualify for conventional financing, your options are cash, which is 100% down, or private financing, which is 40% down. So a lot lower, obviously, than 100% down. Interest rates are between 6.5% and about 8.5%. You can find out on our website exactly how the property financials look. You can use this for solo 401ks, self-directed IRAs, LLCs, individuals. So we'll lend to an individual or a retirement account or a business entity. And we usually require the borrower to make payments for at least 3 years before they refinance or sell the loan. So just something to be aware of and be familiar with. So for those of you that have a 401k from a previous employer, or a IRA account, or a SEP account, or many other different retirement accounts, you may be eligible to self-direct that retirement account, which means roll the money that you have in your current account into a retirement account that allows you to purchase real estate. So currently, if your retirement account's with Schwab or Fidelity or Vanguard or Janus, those custodians do not have self-directed retirement accounts. We work with a custodian. Our main self-directed IRA custodian is IRA Services. They're in Northern California. We've helped hundreds of people set up an account with IRA Services. But the benefits would be, so right now if you have like multiple retirement accounts, you can combine those accounts into one self-directed account to purchase real estate with. So you can either use the cash in your retirement accounts to buy property outright, or you can leverage the money in your retirement account through a private financing loan. But doing that obviously gives you a lot more control over your retirement account. So we've seen the stock market where it's performed over the last 10 years or so. And if you're a savvy investor and if you're purchasing the right properties in the right markets, you can significantly outperform the stock market through whatever mutual funds your retirement accounts are currently in. So it gives you more control over your retirement account. You're not paying that asset management manager to send you those statements every quarter to tell you how your portfolio is doing. And there's also tax-deferred and tax-free options. So if you have a Roth self-directed retirement account, then all of the income that's coming in for your rental property, all of the appreciation is growing tax-free. And so you can definitely set up a Roth self-directed retirement account as well. One of the requirements is that all the rental income stays in your retirement account. All the expenses come out of the retirement account. And if you touch that money before the minimum age, then that would be a penalty. So you want to leave that money coming in and out of your retirement account until you're at that age where you can start taking distributions. Just to piggyback, we work with a self-directed IRA specialist. Many of you are familiar with Dmitry Fomachenko at Sense Financial. He set up countless accounts for our clients, so we work with an intermediary, and our team can help you get connected to Dmitry if that's something you would like to pursue. So another option, which is more of an exit strategy for many of us, is what's called a 1031 tax-deferred exchange. So we have this this thing that exists, this really ugly thing called capital gains tax that only seems to get higher and higher as the years go on. But essentially, when we sell an investment property, any gain, no matter what it is, if we had $1 of gain or more, we have to pay capital gains tax on any gain. $1, $1 million, doesn't matter how much the gain is. The unfortunate part is that capital gains tax is very, very high. We have to pay state, federal. For many of us, capital gains tax can be 25 to 35%. That's probably where it's going to land for most of us, and that's of the gain. So this is different, by the way, when you own your primary. You guys are probably familiar with the $250,000 exemption for individuals and $500,000 exemption for families. That's probably going to cover most of us out there on our primary. But investment property, there is no exemption. The only way to avoid paying capital gains tax is to do a 1031 exchange, and you have to work with what's called a qualified intermediary. And you're looking at Dino Champagne. She's the division manager for API Exchange, that's Asset Preservation Incorporated. They're one of the largest qualified intermediaries in the country. They're a subsidiary of Stewart Title, and Dino's been doing this for well over a decade. We've helped countless people sell their investment property, take the equity, convert that into 2, 3, 4 properties, double, triple, quadruple the rental income. So when would this make sense? Well, if you bought a property, let's say, at the bottom of the market, or in the early 2000s, or 2009, 2010, 2011, and that property's gone up, $100,000, $200,000, $300,000, the rent's probably only gone up a couple $100, where you may have seen the value go up a couple $100,000. And you're saying to yourself, I could buy a lot of property with all that equity. And for whatever reason, let's say you don't want to refinance, this is an exit strategy to sell your property, which is called the relinquished property that you're selling, and your replacement property or properties, as long as you claim a 1031 exchange when you're in escrow on the property you're selling. You can't do it after, that's too late. So you've got to find a qualified intermediary while you're in escrow, identify that as the relinquished property, and from the date you close escrow on that property, you have 45 days to identify all replacement property. You have 180 days from the date you close escrow to close on all those replacement properties. So just a great way to potentially purchase property, take advantage of equity that you have in one property and convert that into many more.
Cool, thanks, Scott. And then just to piggyback off of some of Scott's slides, it's, again, my job to understand you as the individual and get you in touch with the right people if need be, such as Dino, such as Reed and his team. So again, being very transparent with one another is a huge part of what I do and only beneficial to you as an investor. So, all right, continued here. So when, time frame, we covered this earlier, but when is based on your knowledge of the market. So going through those steps with me, understanding what the pros, what the cons are of each one of the markets that we're in has a lot to do with the process. And that's my job, to make sure you're fully aware of each one of the states that we're in currently, which is only going to increase your confidence in that particular market. Again, going back to the resources, getting you in touch with the right team. So just for example, when you and I speak and we narrow down, let's say, to 2 different markets, what I always like to do is get you, the individual, in touch with either the realtor or either the property manager to go over any questions you might have for that particular person. So us 3 will be on constant communication with one another. That's what we, pride ourselves in, is making sure that you have all of the resources available to you and all your questions are being met by the right person. So going on from there, let's see here. Okay. So what is probably, like I mentioned earlier, the most important part of the puzzle? Going over what price point can you afford, but what are you comfortable with? the property class, which I'm going to get into a little bit more detail about. The property class we have is essentially Marshall Reddick's foundation that we've come up with. Along with that, what type of properties, which I mentioned single-family residences or single-family homes, duplexes, fourplexes, the conditions, turnkey, does it need a little bit of money to do repairs as far as carpet or paint, or is it going to be a new property, something within the last 10, 15 years? Age of the property, single family, is it, and these get into more specifics that are going to be unique to you as the individual. Are you looking for something that's a single story, 3-bed, 2-bath, with or without neighboring walls, whatever the case may be? This is where we get into more detail and find out your specific criteria. Now, I do want to mention, if you have been to the website before and you've gone through some of the properties and you're just not finding something that you think is what you're looking for, you're not limited to what's only on our website. So this goes back to us having the conversation of finding what property it is specifically you're looking for once we've narrowed down a market, and then getting you in touch with that our realtor in that area, where we can identify your needs, and what they'll do is find your specific criteria and send it to you directly. So I want to make sure that you guys are fully aware that you're not limited to just what's on our website. Okay, determining criteria. As I mentioned earlier, I was a financial advisor before I started in the real estate business, and this is exactly the same steps, almost the identical questions that I would go through with clients of mine that are looking to retire in 5, 10, 15 plus years. They just transitioned jobs. They have an old 401k. They have some money that they want to obviously put to use for them, instead of just having them sit in the bank getting 0.01 interest or return on their investment, right? You want to make sure your money's working for you. So this is what we're going to do that's very, very important. So we first want to identify what it is that we're looking for. Are you looking for cash flow, or are you looking for more of appreciation? Both of these are going to be unique to you as an individual. Some people want that extra cash flow for whatever purpose now. A lot of the clients that I help find or identify properties that are specific to cash flow are those who are approaching retirement and want to supplement their income. So other people, like one of my buddies who I actually just helped buy a home, is a B-class property. He is approaching 30. He's not married, doesn't have any kids, very little overhead. He's in a great job where he's making enough money, so he doesn't care about the immediate cash flow. So what we do with him, or what I identify with him, is finding out properties that are going to appreciate more over the course of 10, 15, 20 years down the line to when he does retire. So neither one is better or worse than the other. It's just more specific to you. So again, how much experience do you have? I mentioned earlier I help people who this is their first property, have no idea. They just stumbled upon Marshall Reddick by searching on Google of how to buy investment property, and here you are. Other people I've helped purchase multiple properties with. They've had the experience, but they still want to identify other areas that we're in and help and utilize me to get in touch with the right people. So what is your risk tolerance? This all goes back to these questions. All will tell me or give me an indication of where you fit on this chart below, luxury or D-class property. Your risk tolerance. Do you have a high risk tolerance? Are you very risk averse? Finding out what is appropriate to you. And then, of course, can you qualify for financing, and what can you afford? So I will get into the slide or the property classes in a little bit more detail later on. But for right now, here is the fundamentals of Marshall Reddick's property class rating. So anywhere from luxury, A, B, C, and D down the line. As you can see below, you can have get a very clear understanding of which each side means. So when we look at luxury and A-class properties and B-class properties, those are the ones that are going to tend to appreciate more in the long run. Nicer school districts or better school districts, lower crime rates, in a little bit better part of town at a little bit higher price point. As you get towards the lower levels of B, C, and D, it's going to be the opposite. So you're going to get more cash flow because of the price point of these homes. So the lower the price point, relatively the same rent as far as what you're charging your tenants is going to increase your overall cash flow. Now, of course, the reason why that you're receiving more cash flow and because it's at a lower price point, it's probably because it's not in as nice of an area as a luxury or A-class property, and you're going to be receiving usually different types of tenants. Usually more tenants that are going to have more turnover, what we've seen throughout Marshall Reddick. Now again, neither one of these is better or worse than the other. It just depends on what you're looking for. So you can find the ebook, which is now apparently available on Amazon, which is pretty cool, and as well, of course, on our website that you can download on PDF for free. And let's get that going. Same slide. Okay. So when you go to the website and you download the PDF, this is one of the pages within the ebook rating. Now it's going to go into detail as far as, okay, these are the types of tenants I can expect to have when looking at luxury A, B, C, and D class properties. Now just to kind of, throw some things out there for you, we don't, I want to say 99% of the time we don't offer luxury or D-class property. Luxury is because the price point is too high. It just doesn't make sense for investors as far as receiving any type of cash return. And then D-class, you're going to get into Section 8, and it's just not something you want to deal with when having passive income. It's more of a headache for you than a benefit. So things that really matter when looking at property class, as you can see right below, are obviously the price point, the cost per square foot, school districts, and crime rates. Cost per square foot, you can easily compare something in New York or parts of downtown LA to Kansas, right? So a 900 square foot apartment in New York is going to be completely different as far as the price point with a 900 square foot apartment in Kansas or somewhere in the Midwest, or essentially pretty much anywhere besides New York. So things that really don't matter when evaluating investment property is whether it's a house, condo, or apartment, property age, property size, property condition, because most of those can be improved with rehab. And again, the property age is not a huge factor as well when looking and evaluating property classes. So just a kind of a little bit of an acronym for you guys to remember what I meant by A, B, and C class property. A stands for appreciation, B has a combination of both, and then C, you're looking at more cash flow oriented properties. All right, so on our website, this is going to determine the A, B, and C class property. So the first thing we look at when each one of our metropolitan markets is determining the median home price in that metropolitan market. So how do we find that? If you actually click on the picture below from our website, it'll take you to that particular metropolitan market, and this is all gathered by the National Association of Realtors, and it'll identify the median home price in that particular market. Now, once you have that median home price, we always peg that to 100%. So A-class property is anything that falls from the 100% of the median home price up until 1.3 times that can be considered an A-class property, and as you can see, a B-class and C-class and the percentages in between for those. On the top, there's a little bit different as far as a single family versus a multifamily, and you can see the breakdown of where we're going to peg the median home price at 100% and then also 90%. So just to kind of give you an example, you know, the median home price in Orange County is going to be around $650,000. Now, if we were looking in, you know, Texas or Oklahoma with that same price point, we're going to be well into the luxury class, probably close to 200% of the median home price. So you can just see and get an understanding of how this system works. Each home that you're in currently right now will fall into one of these property classes depending on where you live. So along with the property class, here comes one of the most important and crucial pieces to how we factor in return on investment and cash on cash return, which most people, when looking at cash on cash numbers, won't factor in or won't give you the full percentages for these. So we've been doing this for almost 40 years now, and through trial and error and through experience, we've identified the A, B, and C class properties and what you should factor in each month for these to not to pay for these when these, not if they occur, but when they occur. So we look at every single one of our financials or examples over a 15-year time horizon. So when you're looking at A class, B class, and C class property, each property class is different as far as the type of tenants, the condition of the property, the location of the property, how the tenants treat the property, and that's going to have a major impact on what you pay for maintenance and what you pay for vacancy. So as you can see right now, we break it down for you very simply to what we factor in or what you should factor in each month to get the most accurate depiction of what you will be receiving over a 15-year time horizon. So A class we factor in because it's in a better area, better neighborhood, usually probably, or it's going to be probably a newer home than you would find as a C class property. We're going to have a less of a maintenance expense than we would a B or a C class property. Same applies for vacancy. What's an A class property? You're probably going to get that white collar employer who has a family, who just either moved to the area or is looking to settle down, who's owned in the past or is looking to own. So you won't see as much turnover with an A or B class property as you tend to would with the C class property. So same principles apply with the C as they do with an A. And then of course when you break that down, there's just a little bit of discrepancy when you get into more than 5 units with the A and the vacancy and maintenance rates right there. And if you have any questions on how we come up with these or why we come up with these are not expenses that you're going to have to be paying every single month, but we want you to make sure you're factoring these in when calculating your cash on cash return and total ROI. And we do have a calculator on our website where you can actually plug in these numbers or plug in a specific property that you found on your own and plug in these numbers that we have for you already established and see what your ROI and cash on cash return is. So I just want to do a quick example here for you just to get you guys thinking as far as what this really means. So we're going to do an A-class property. So there's 365 days a year, and we're just going to do a maintenance and vacancy, or we're going to do either one. So with an A-class property, every single month, let's just do this as vacancy. We have 8% allocated to an A-class property. So when you times 8% by 365 days in a year, that comes out to about 29.2 days a year. Now that you're not going to have 29.2 days a year that your property is vacant every single year. That's just what we find on average over the 15-year time horizon. But when you think about it, it's extremely conservative because that's almost exactly 1 month without rent. Now I'm not sure how many people have owned in the past or have had the experience of dealing with property management either with themselves or with the property management on your own. That's very conservative as far as what to expect when taking out the tenant, or if a tenant's being replaced, finding a new tenant, going through the home, cleaning out the home, sending pictures to you as the landlord, you getting back to the tenant or the property manager, having to property re-inspected again with either the carpenter, the plumber, whatever needs to be done, screening new tenants. A month is a very conservative number to deal with turnaround on vacancy. So I'm just going to give you guys an example of how this system works. And again, I can go through all this in more detail with you. If you like, just let me know, email me or call me, which I'll go over at the very end. All right, so I told you guys that we're going to have a few polls throughout tonight's webinar. Here's the first poll, which I will go over with you guys. Scott will get that pulled up for you, but these are all anonymous. They are strictly, confidential to you, but I like to share these with the entire class to get an understanding of, how you guys are doing or how you're understanding each one of these. So first question is, what is your target property class? So like I said, what I went over is the A, B, and C class property pretty briefly, but I'd like to just get a gauge as far as what you as the individual and investor are thinking. So I'll give you guys about 15 seconds or so to answer this question. There is no right or wrong answer. Trust me, it's fine. And then I'll get back to you guys.
All right, we got some stragglers. We're only at 50% of you that have voted so far. So
hopefully we didn't put you to sleep.
Hopefully you're not in the next room, in the living room. Yeah. You just got to click a button.
That's all you got to do.
Thanks, guys. Yeah, we appreciate all the votes coming in. There's one that's clearly in the lead, and then we've got a few others that we got some votes on. And
by 5 more seconds or so to wrap it up, and then we'll go over this poll with you guys. All right.
Let's share.
Polls are closed. Cool. So, for the most part, it's a landslide. Yeah. So, looks like most of you guys are leaning towards the B class property, which is great. Now, A class property, like I mentioned, there is no bad or worse. The A is not better than C, and C is not better than A. Just whatever applies to you in your unique situation. But yeah, for the most part, it looks like people are B class property investors.
For the best of both worlds.
Yeah.
Okay. So. For the rest of the presentation, I'm going to be covering the remainder of the steps in the process, and I'll try to keep things kind of just short and to the point for you guys. But the next step after building your criteria and understanding your property classes and what type of properties we're looking at is to then start looking at where. So we really have to pull back, and in this day and age, in this real estate market, with the technology that we have, the resources that we have, no matter where we live, even if we're international, we can look at the U.S., the continental U.S., and say, where does it make the most sense to invest? Not because of where I live or where I grew up or where I work or where I travel, but where does it make the most sense financially to invest based on my goals? So this is kind of how we look at it here at Marshall Reddick, and this is the system that we've had in place for many, many, many years. So the markets that we're in, there's about 15 of them on our website. We choose based on these 7 factors. So we start off with the job market, and we look at where do we see the most amount of job growth, where's the trends, where's the major employers setting up more and more locations. It's amazing that there's only a handful of states where we see continued job growth year after year after year. Has a lot to do with the taxes in those states, with the weather in those states, with basically what's driving the demand to buy and rent, which a lot of it, of course, has to do with the job market. The job market and the job growth does have an impact on the short-term vacancy rate. So we know that in places like Austin, Texas, Dallas, Texas, Cape Coral, Florida, with this just incredible job growth, that when you buy a property, if it's rentable, if it's rent ready, and if it's priced correctly, that we will probably see that property get rented out in under 30 days or less, with obviously the proper property management. We also know that in more sluggish areas with a little bit more depressed job market, that it's gonna take longer most likely. There's less people moving out there, less people, smaller rental pool. In addition to that, we look at the diversity of employment. How many different industries are supporting that market? Of course, since we're buying investment property, is the affordability rate higher than the national average, and how much higher? How many properties or how much real estate can we buy for that dollar in one market versus another? We look at the landlord laws. So are they landlord friendly or tenant friendly? For rent restrictions, evictions, do the laws favor the tenants or the landlord? So obviously we want to be in a landlord friendly state when we're buying investment property so that we have all the odds in our favor. What's the education like in that market? Are there colleges and universities that are attracting students who are future employees in that market? Are they creating education that support the local jobs that will continue to thrive in that market? And then lastly, is there reliable property management? None of this works without reliable property management. So here's our strategy for selecting markets. Now I've put a few of our markets in here. This is 4 out of about the 15 or so that we're in. But what you'll notice in Memphis and Phoenix and Austin and Indianapolis is I've actually circled the towns and the cities that we sell most of our real estate in. And I wanted to illustrate an example that we choose the suburbs of major metropolitan markets. So first we start off with that metro of Phoenix or Austin or Indianapolis, and then we look at the suburbs because, as you'll see on the next slide, by the way, if it's hard to read, I'll just cover it quick. So Memphis, we look at places like Bartlett and Cordova. In Phoenix, it's the West Valley or the East Valley, so Goodyear, Glendale, Peoria on the left, and Mesa, Gilbert, Chandler on the right. Austin, you'll see that the growth is north and south, so Round Rock and Pflugerville and Georgetown on the north end, Kyle and Buda on the south end. Indianapolis, outside of that perimeter, right outside of that circle, you'll see the best, most ideal places, affluent areas with good schools and good quality tenants in places like Noblesville, Carmel, Fishers, on the west side, Brownburg, Avon. So let me show you kind of to start. Why do we invest in major metropolitan markets? Why are we in these huge cities? So very, very simple. This is all common sense stuff. When we're buying within a major metropolitan market, for starters, we're going to have a larger base of potential renters. We want the most amount of potential renters for our property as possible. We want the largest rental pool as possible. And in state capitals or major markets, we're more likely to see a diversification of employers. We're going to see government jobs, healthcare, education, trade, manufacturing, agriculture, technology. We're going to see finance. We're going to see all these different industries supporting the job market there that are pulling in jobs from so many different angles. And then a higher selection, a larger selection of professional property management. So if we're buying a property in a small town 2 or 3 hours outside of a major metropolitan market with a population of 30,000 people, there may only be 1 or 2 property managers in that market. With that low amount of competition, unfortunately brings just the absolute worst property management possible. But when you're in a big market like Phoenix, there are hundreds and hundreds of property managers there. So the fees are low, customer service is generally strong because they know there's so much competition. Property managers are a dime a dozen in these large markets. With all that job growth comes a higher chance of population growth. With all that population growth comes a higher chance of future appreciation. So when we look back at the last 4 years and we look at what cities experienced the highest appreciation and value, they're all major metropolitan markets. But why aren't we buying in the downtowns? Why aren't we in the downtown Phoenix? Why aren't we in the heart of Memphis? Why aren't we in the heart of Indianapolis? So these are the reasons why you want to be in the suburbs of major metropolitan markets. We're going to have better school districts, lower crime rates, newer properties. We're going to attract families, and families are exactly the type of tenants that we want. When we look at buying 3-bed or 4-bedroom properties, in many cases single-family detached homes, that's kind of our bread and butter, we're looking to attract a family, 1 or 2 kids, 3 kids. You know, backyard, front yard. Their kids go to the local schools. You know, they engage in the local community activities. These are people who are planted in this area and are most likely going to stay in our property for a long time, most likely to take better care of it as well too than transient tenants, maybe 2 friends or 3 friends, or you know, a lot of people talk about student housing. I'm not at all big on that. You know, Garrett and I both went to college. I mean, you know, it's just, this is not a long-term type of, you know, type of thing. When you have a family, you have a long-term tenant, 1 or 2 jobs, you know, possibly dual income, more likely to stay in that property for much longer and take better care of it. So that's why we're in the suburbs. These are our markets. You'll find them on our website. Many of these markets we've actually had a local presence in for well over a decade. I mean, we've been working with the same team in Cape Coral, Florida now for coming on 11 years. Austin, you know, we've been working with the same team there for like 5 years. Clarksville, we worked with the same team for 20 years before our time. So, you know, you guys know our office, Marshall Reddick Real Estate's office, is located in Orange County, California. But outside of Orange County, each one of these states, each one of these cities, we have a local licensed buyer's agent and a property manager that we've been working with on a contract basis for many, many years. So all of our agents out of state, all of our property managers, all of their handymen, plumbers, they're not Marshall Reddick employees. You know, these are independent offices. They have licenses in their states, and we contract them out. We've been working with the same team, the same dedicated team in each market for many years. So, you know, if we stick to what works year over year, we probably won't see a lot of change in our markets. We probably only add or take away like maybe 1 market a year. I don't think we have plans for really adding any more. I mean, these are the markets that work, and so there's no reason to stray from our model. So I just want to show you guys a couple neat things, a couple tools on our website before we wrap up. On our website, you'll find the 25-year appreciation trend for every market. I pulled Fort Myers, which is part of Cape Coral, Florida. So we're able to see the last 26 years of year-over-year median home prices in every market we're in. All the data comes from National Association of Realtors. So we're able to see all this information directly on our website. This is just a great example property. I pulled this one off our website. This is a B-class home in the Cape Coral, Fort Myers market. Just real standard type of property that we look for. Built 2005, as you can see right under the picture. So it's a newer property, 3-bed, 2-bath, on a quarter-of-acre lot, listed at $163,000. Rent projections are $1,450 a month. All these financials you'll find on every single property on our website. So you'll be able to see exactly what the mortgage payment quote is based on, this is a 25% down quote. You'll be able to see what the current county taxes and city taxes are, what the insurance premium is annually or monthly. This comes from our insurance agent. What our local property management team charges, which is 8% in this market. Commonly, you'll find about 7 or 8% of the monthly rent as the property management fee. This is not in an HOA, so there's no HOAs. Tenants are paying utilities and landscaping. So our operating expenses and our mortgage add up to about $1,003 a month. So where it says monthly income, that's coming to you every single month. That's basically what many would consider your cash flow, $446 a month. Now, Marshall Reddick is very unique because we estimate maintenance, we estimate vacancy, we add in a leasing fee, which is what the property manager is going to charge you anytime that they procure a new tenant. So where it says monthly cash flow, $115 a month. Now you have to keep in mind, that's a long-term 15-year average. That's not what you're going to be making every single month. Every single month, while it's rented, while you don't have maintenance, you're making that $446 a month. But you're putting away the reserves for maintenance and vacancy when it comes up. We don't have any rent estimate quotes in here. You may end up seeing rents go up over time. We don't have any exact reliable data, that we can share, so we just kind of leave that out. But here's a great example property in Florida. I'm going to move on to Memphis. Memphis, it does not have the ups and downs that we see in like Florida or California. More of a stable market, so not as much year-over-year appreciation, but also not as much decrease in value either. So Here's a great property. This is also a B-class home in Memphis that sold to one of our clients recently. You'll notice in Memphis there's a closer margin in the price and the rent. Now you're trading off the appreciation for higher cash flow. So this is where we want to figure out what your goals are, where our advisors like Garrett will help you figure out what markets and what property classes make the most sense for you. But this is also a newer property built in 2004, 3-bed, 2.5 bath, 1,800 square feet, 7,800 square foot lot size for $130,000. And this is actually a turnkey home. So we work with a turnkey provider in Memphis that purchases, rehabs, and sells properties completely rent ready to our clients. So if that's something you're looking for, that's definitely an option that we provide to our clients as well. We don't want you guys to just blindly go along with our recommendations. So we have a detailed market data packet on every single area that we're located in. So these are just a few of the markets, but you'll notice that on our website you can download these for free. They are about 20 to 25 pages, and you'll find everything from major employers, vacancy rates, the demographics, percentage of jobs in different industries, the job growth trends, recreation, major attractions. So if you're not really familiar with these cities that we're talking about, and you're saying to yourself, well, I don't know anything about Memphis or Austin, you know, you can, in click of a few buttons, you can become an expert on these areas just by downloading the data packets directly on our website, located on the Learn tab. Yep, I think that should be it. And so we'll take another quick poll, and then we've got about maybe another 5 minutes or so. I just have a couple more things to cover with you guys. We appreciate everybody staying on here. We're just slightly over an hour. Got a few more minutes to go here. So I want to throw in one more poll question. Love to just kind of take a pulse to see your guys' thoughts on some of the markets we discussed. So the poll question asks, which metropolitan market interests you the most? Mm-hmm. And you know, we've taken kind of 4 of the ones that we covered. There's a lot, obviously, many other ones that we're located in. Right. But of those 4, or of the additional ones, love to get your guys' just kind of feeling on which markets are really interesting you the most. And I'd love to share. This is always very interesting to share. We never really know exactly what the answers are going to be. So I'll give you guys, you know, 10 more seconds or so to fill out those responses. You can only choose one, so it's tough. But you know, this is not a life-threatening decision, so don't worry too much. Okay, a couple more seconds, and thanks everybody for your votes. This is pretty interesting, actually. Okay, all right. Well, thanks for playing along. So here's the results. We've got a lot of people actually interested in Phoenix, but we've got you know, kind of an even spread in the other markets. And maybe some of you are more familiar with those markets. Maybe you own property there already, but I think what this illustrates is a good example that no 2 investors are exactly the same. Everybody's got different goals and criteria. Good thing is that we offer a lot of options for you folks. So, all right. So as we continue, I want to share with you where you can find all these resources that we covered tonight. So the market data packets, the 25-year appreciation trends, the property financial calculator, all of this can be found on marshallreddick.com/learn. All free information. In fact, we're recording this presentation. You'll find the recording posted on there probably by the end of the day tomorrow. You can see on the left, you can filter the category you're looking for based on article, video, guide, calculator. We've got, you know, as you can see, just over 100 articles, close to 100 videos. You can search based on the topic. We have over 50 topics related to real estate investing. So just a really wealth and just a complete online school of real estate investing. College course, but more. All for free. So a lot of good information that I recommend you guys take a look at after the presentation. You can utilize our web-based and very comprehensive property financial calculator on marshallreddick.com/property financial calculator, no spaces. And you can plug your numbers in. You can plug in the prices, the rents, play around with the appreciation rates. There's pie charts. There's graphs to choose from. There's a lot of tooltips that help explain what all these fields and definitions mean. You can switch between looking at it on a monthly basis, yearly basis. You can change the method of purchase from conventional financing to cash to private financing. Very, very helpful. I find this is one of the most eye-opening steps for investors to really understand what expenses, what income, what needs to be evaluated when calculating the numbers for a real estate investment. So free calculator, that's our gift to you, something that we spent literally years on, hired 2 full-time web developers, and we really hope that you guys enjoy using it. And kind of the last thing that we didn't cover yet is the who. So I'm going to go through this pretty quickly, but all of these people that you see on here are key players that will impact the success of your investment. Doesn't matter how smart you are, how much money you have, how much experience you have. Real estate investing is a team sport, and you've got to rely on the experts. So here at Marshall Reddick, we have advisors like Garrett, who are also licensed realtors that own property, that have experience, that look at everybody on an individual basis to really help you put together that entire plan. And then we'll look at the options. So we'll help figure out what options you have. We'll put you in touch with the proper lenders, the proper self-directed retirement account specialists, you know, our private lender, Patrick, if you're looking at private financing. Depending on the market you're purchasing in, we'll put you in touch with our local regional rep. We call them regional reps, or the local realtor that we work with. When you're in escrow, when you're under contract on a property, they're going to recommend that you order a building inspection. They'll give you a few recommendations on building inspectors to choose from. You want to have the proper insurance coverage, and we'll be able to connect you with a couple, with an insurance agent. We work with Stan Dreckman. He has a few different insurance providers, and we'll help you get the best coverage for the best price, basically. So we look at not just price, but also coverage. And then property management, to continue managing that property, getting it rented, being, your point of contact year after year for as long as you own that property. So when you're looking at, verifying Marshall Reddick, if you're new to us and you haven't researched us, we are all over Zillow, all over Yelp. Any good realtor or broker, you should find high ratings on both of these websites, a lot of reviews. Right now, I think we're at like about 70-something reviews on Zillow and 60 on Yelp. So read what other people are saying about any individual you're working with. You can find lenders on here, agents on here, insurance agents, property managers. So this stuff helps. This is online review stuff in the world we live in now. This is very important. I kind of covered this already, so I'm not going to spend too much time on it. But it doesn't matter what lender you work with. Just make sure you're using a direct lender. Make sure they have dedicated in-house processing and underwriting. Make sure they specialize in purchase transactions, that they have good online reviews, that they're responsive and available on nights and weekends, and then lastly, that they're able to do what's called a fully underwritten approval. A lot of lenders won't do that because it takes a lot more time and it's a lot more effort on their end. But this is basically a fully underwritten approval is very different than a pre-qualification. It's a loan approval that doesn't require a loan contingency at the offer stage. So essentially, it's just about as good as cash. So they're going to look at your W-2s, your tax returns, all your mortgage statements. A lot more work in the beginning, but when you get that approval and you make that offer, your offer is going to stand out. It'll compare, with the seller. It'll look just as good as cash. It'll close in, under 21 days on average. It's just very important in competitive markets, and we are in some very competitive markets right now. A lot of lenders won't do that. Our guys at AMERIFIRST will, because they get a lot of business from Marshall Reddick clients. As I said, Stan Dreckman, he's an awesome insurance agent. You'll see him at a lot of our events here in Orange County and LA and San Diego. We've been working with him since I think like 1998. He's written policies on thousands of insurance policies on thousands of properties. I put his phone number up there, but when you're looking at pricing insurance, our advisors like Garrett can connect you with Stan, who can basically get you the best coverage, highest liability coverage, whatever deductible makes sense for you, to really get that coverage with the lowest price. Last but definitely not least is, what do we look for in out-of-state property managers? So obviously we do property management here in-house, but in Arizona, Florida, Texas, Indiana, how did we choose the property managers that we work with? So we look at, are they heavy online presence? Do they have good reviews? Is there a conflict of interest in maintenance? Do they make money from maintenance? That's a huge conflict of interest for many property managers out there. Yep. If that property manager isn't directly making money from maintenance, that means that their interest is entirely vested in helping you get the most amount of income for the lowest expense. I'm really not for property managers who are licensed contractors who are making money from all that maintenance. A lot of property managers will add a 10 or 15% markup on top of any maintenance that they coordinate without a third-party contractor. So even if they coordinate a third-party contractor that they don't have any ownership in, you'll have to look at their agreement. A lot of property managers will actually charge a fee for overseeing that. So good property managers make no money whatsoever from maintenance. What's more important to you, cost or service? So if you're hiring a good property manager, they're probably not going to be the cheapest. They shouldn't be the highest either. They should be somewhere in the middle and provide the best service and have the best reviews, best ratings. Are they responsive? So it's very important. All the property managers that we work with, we manage them heavily. We've chosen many of them because of how quickly they respond, how proactive they are, how easy they are to get a hold of. That will also trickle into their communication with tenants and prospective tenants who could be renting your property. Online reviews, obviously we talked about that. What's their cancellation policy? Is it flexible or is it rigid? Do they try to lock you in for a year? So all of this is going to be spelled out in the written management agreement that you have with your property manager. And all of this has passed our standard of business with all the property managers that we recommend. All right, so we're at the finale here. So, these are some of the potential risks that we run into in investing in real estate. Long periods of vacancy, high maintenance, evictions, property values going down, natural disasters. So these are just, liabilities. So these are some of the risks that come along with real estate investing. So our entire program, I'm going the wrong way. Our entire system at Marshall Reddick is designed to limit the potential risks as much as possible. And this little pyramid here you see in front of you illustrates how you can lower your risk. So we're literally articulating to you right now how to keep your risks down as much as possible. I can promise you, if you do not follow these tips, you will likely run into higher maintenance, higher vacancy. In this day and age, when it comes to property values, buying an investment property, you have to put at least 20% down. You may want to put a little bit more to get a lower rate and have lower mortgage payments, but as long as you have monthly positive cash flow, if values drop, then you still have enough income to hold you through. It's kind of the glue that holds it together long enough to wait for that appreciation to come back. So sorry I jumped to the third one there, but if we go back up to the top, we talked about vacancy and maintenance, and we mentioned how higher property classes tend to have lower vacancy, lower maintenance. If we're buying within a major metropolitan market with all that job growth, all that population, all that demand, we're likely to just have an easier chance renting properties out. Of course, professional property management. Don't do this on your own. That is just one of the cardinal mistakes where people think, well, I can do this on my own, even though I have a full-time job and I have kids and I have a family and I have a life. So, property management, real estate waits for no one. When you've got an issue on your property, it needs to be handled immediately. Right. So maintenance, same thing. If you have a home inspection, you do that building inspection, you'll find out the exact condition of all aspects of that property when you're buying it. That way you know what potential maintenance you may have over the next year or two or three. Higher property classes are going to lower your maintenance. And then, of course, if you're buying a new property or turnkey property, you're, of course, going to have less potential maintenance since it's been remodeled or it's a new property. And then jump down to the bottom, having the proper insurance coverage, whether it's wind or hail or fire or earthquake, will protect us in those natural disasters. So if you guys do all these steps and you work with an advisor and they help you through this process, I know it kind of seems like a lot of information, and we've covered a lot tonight, but this is exactly what we want you to look like after you close escrow on your rental property.
That guy.
Who is that guy right there?
The beard's in the way. The beard's in the way.
So yeah, I mean, for those of you that know me might not recognize this photo because I don't have a beard anymore. For those of you that don't know me, that was shortly after I closed on one of my investment properties in Phoenix. I was obviously pretty happy that day. And so that's exactly how we want you to feel when you work with Marshall Reddick. You know, we aim for customer satisfaction. We aim for positive reviews. We aim for referrals. And we aim for a continued lifelong relationship with each one of our clients. So when you're working with Garrett, he's going to walk you through each one of these steps. As we discussed already, it's not an immediate overnight process. Yep. Some people are in a position to do this now. Some might not be for 6 months, 12 months, you know, a couple years. So we'll help each one of you go through this process. And the best part is we'll do it for absolutely free. Some of these consultations may be 10 minutes. There might not be a lot to discuss, might not be in a position to do it. Sometimes these consultations go an hour. It just depends on the individual, their time frame, and their interest level. So as our gift for sticking around for almost an hour and a half, we're going to allow you guys to have a free consultation with Garrett, and he'll get back to you guys on a first-come, first-served basis. We've got his phone number on there, 949-885-5172, and his email, gstasand, S-T-A-S-A-N-D, at marshallreddick.com. I'm gonna have Garrett say a couple words, and then we'll finish up. But one thing I want to stress is you have absolutely nothing to lose by having this consultation. It doesn't obligate you whatsoever to have to buy property or buy property with us. Completely non-committal, completely non-pressure. And I think you will gain a tremendous amount of insight from talking to Garrett and going through these steps. So,
yeah, thanks, Scott. No, I appreciate you guys sticking around for the hour and a half. But what I really like to see out of, you know, what I like most about the job is just seeing that last picture for my clients in front of their home. So making sure that you're finding the best property for your situation and, you know, taking the right steps for you. Absolutely no pressure. You know, it's don't worry about, you know, not going through with something. As long as we're always transparent with one another, that's all I care about. So, you know, again, anytime you guys want to chat with any questions regarding real estate, your primary investment property, or if you know someone that's like-minded, you know, just like yourself, who you think would benefit from a consultation, who couldn't make it tonight, or you just know that would benefit, send them my way. I'd love to chat with them and you know, hopefully help you guys out. So again, appreciate you guys sticking around. Like seeing all you guys on, especially all of the clients I've worked with in the past. So yeah, any questions, give me a call, email me, and then have a good night.
All right. Thanks so much, everybody. Good luck, and we look forward to talking to you more in the future. Thank you.
All right. Have a good night. Bye.